What is happening, crypto fam? Welcome back to Bitcoin Bulletin, the only place you need to be for the absolute hottest takes and the deepest dives into the world of digital assets. The market is moving at warp speed, and if you're not plugged in, you're getting left behind. We've got a packed show for you today, with seismic shifts happening across the board. Get ready, because you do not want to miss what's coming up next. We're talking about major institutional plays, surprising government moves, and a critical look at the forces shaping our favorite digital currencies. Stick around, you won't want to miss this. First up, we're diving deep into the on-chain signals that are pointing to a massive influx of institutional interest in Ethereum. Is this the catalyst we've all been waiting for? And what does it mean for the ongoing debate about the Bitcoin-Ethereum dynamic? We've got the data that could change everything. Then, we're heading to Capitol Hill, where a U.S. congressman is making waves with a bold proposal. This lawmaker, who's seen incredible personal gains from his early Bitcoin investments, is now pushing for the government itself to become a major crypto holder. We'll break down the specifics of his plan and the controversy it's stirring. And we're not done yet. We'll also be dissecting the delicate balance of Bitcoin's market, looking at the impact of large holders and the persistent challenge of ETF outflows. Plus, we'll explore why Ethereum might be positioning itself for a utility-driven boom in 2025. It's a lot to cover, so buckle up and get ready for the Bitcoin Bulletin. Don't forget to smash that like button, subscribe, and ring the notification bell so you never miss an update. The institutional ETH surge, on-chain signals, and the Bitcoin-Ethereum divide. Are we on the cusp of a new era for Ethereum? Market watchers are buzzing as on-chain data reveals a significant uptick in institutional accumulation of Ethereum. This surge in interest from large-scale investors could signal a major shift in the digital asset landscape, potentially recalibrating the long-standing competition and comparison between Bitcoin and Ethereum. The analysis of on-chain metrics, which track the movement and holding patterns of cryptocurrencies on the blockchain, is providing unprecedented insights into the strategies and confidence levels of these sophisticated players. For months, the narrative has often centered on Bitcoin's dominance, particularly with the advent of spot Bitcoin ETFs in the United States. These financial products have opened the doors for traditional finance to allocate capital into the flagship cryptocurrency, leading to significant inflows and price appreciation. However, the latest on-chain data suggests that Ethereum is not merely playing catch-up, but is actively building its own momentum, driven by a different set of fundamental strengths and a growing ecosystem. The intricate details of these on-chain signals are crucial for understanding the underlying health and future trajectory of Ethereum. Analysts are scrutinizing metrics such as the increase in large wallet holdings, the velocity of ETH moving to staking contracts, and the net exchange flows, all of which are painting a picture of increasing institutional conviction. This trend is particularly noteworthy given Ethereum's ongoing transition and development, including its successful merge to a proof-of-stake consensus mechanism. This upgrade has not only made the network significantly more energy efficient, but has also introduced staking rewards, offering a yield-generating component that is highly attractive to institutional investors seeking both capital appreciation and passive income. The ability for institutions to stake their ETH holdings directly or through regulated custodians provides a compelling use case that Bitcoin, in its current form, cannot replicate. The divide between Bitcoin and Ethereum is often framed as a battle between store of value versus a platform for decentralized applications and smart contracts. However, the current on-chain activity suggests that institutions are recognizing and valuing both aspects, potentially allocating capital across both assets based on distinct investment theses. The data indicates a growing belief that Ethereum's utility, driven by decentralized finance, DeFi, non-fungible tokens, NFTs, and its expanding Layer 2 solutions, is beginning to unlock its true potential, making it a highly attractive proposition beyond its speculative value. Public reaction has been a mix of excitement and cautious optimism. Many in the crypto community view this institutional embrace as validation of Ethereum's technological advancements and its potential to underpin a new digital economy. However, some analysts caution that the market is still subject to broader macroeconomic factors and regulatory scrutiny, which could influence the pace and sustainability of these inflows. The conversation is increasingly shifting from if institutions will invest in crypto to how and which assets they are prioritizing. The current on-chain signals for Ethereum suggest a strong yes to the latter question, potentially setting the stage for a significant reevaluation of its market position relative to Bitcoin. But is this institutional surge enough to shake up the established order? Next, we're heading to Capitol Hill for a look at a congressman's personal crypto success and his surprising legislative proposal. Rep. Nick Begich did well with Bitcoin. He wants the government to own some too. A congressman's personal crypto success story meets bold government policy. Alaska Congressman Nick Begich has become a notable figure in the cryptocurrency space, not just for his legislative initiatives, but also for his personal financial success derived from early Bitcoin investments. Begich recently disclosed that a modest initial investment of $100 in Bitcoin back in 2013 has grown into an asset now valued at approximately $760,000. This remarkable growth underscores the potential of early adoption in the volatile digital asset market. His journey began with simple curiosity about how Bitcoin worked, leading him to purchase small amounts incrementally. The total initial investment, he estimates, was around $5,100. However, his early involvement was not without its challenges. In 2014, he experienced firsthand the risks associated with cryptocurrency exchanges when Gov't, where he held a significant portion of his Bitcoin holdings, declared bankruptcy. This event left many customers, including Begich, in a difficult position, facing the loss of their digital assets. Fortunately, the initial $100 investment that he held onto separately was not affected by the Gov't collapse and has since experienced astronomical growth. If he had retained all the 440 Bitcoins he held at one point, their current value would be an astounding $48 million, illustrating the immense wealth creation potential that has characterized Bitcoin's history. As a member of the U.S. House of Representatives, Begich is required to report his assets in broad value categories. His latest personal financial disclosure indicates his crypto holdings fall within the range of $500,000 to $1 million. He confirmed that the calculation based on his initial $100 purchase, yielding $760,000, is accurate. Begich has become a proponent of government adoption of cryptocurrency, sponsoring legislation that would position the United States as a significant owner of digital assets. His bill, and a companion Senate bill sponsored by Senator Cynthia Lummis, RYO, proposes that the U.S. government should purchase 200,000 Bitcoins annually for 5 years. At current market prices, this would translate to an annual investment of over $20 billion, a substantial commitment that echoes a previous executive order signed by President Trump regarding a strategic Bitcoin reserve. Begich likens this proposed reserve to the nation's gold reserves, viewing it as a strategic repository for storing wealth. He argues that acquiring and holding cryptocurrency assets aligns with national financial strategy. However, the proposal has drawn criticism. Noah Bookbinder, president of CREW, Citizens for Responsibility and Ethics in Washington, raised concerns about potential conflicts of interest, stating that such a bill could increase the value of the specific cryptocurrency Begich personally owns. While legal, Bookbinder suggests it creates an unfavorable appearance, as lawmakers should prioritize national interests over personal financial gain. Begich defends his position by noting that many Americans now own Bitcoin and that he holds diverse assets. He draws an analogy to homeowners benefiting from lower interest rates and advocating for them, asserting that personal benefit should not preclude advocating for policies believed to be in the broader public interest. He also clarified that he has not traded Bitcoin since becoming a congressman, and his only purchases were in 2013. Furthermore, he noted that he and his partners eventually recovered over $1 million from the Gov't bankruptcy, mitigating the initial loss, though acknowledging it was significantly less than the current value of those holdings. But is this government embrace the right move for the nation's financial future? Now, let's shift our focus back to the market dynamics, where Bitcoin's stability is being tested by powerful forces. Bitcoin's fragile equilibrium, whale-driven volatility, and the ETF outflow dilemma. Can Bitcoin maintain its footing amidst market pressures? The cryptocurrency market is currently navigating a period of heightened volatility, with Bitcoin's price action being significantly influenced by the actions of large-scale holders, often referred to as whales, and the ongoing trends in Bitcoin exchange, traded fund, ETF flows. These two factors are creating a delicate equilibrium that analysts are closely monitoring to gauge the short-term and medium-term outlook for the digital asset. The influence of whales, individuals or entities holding substantial amounts of Bitcoin, can lead to pronounced price swings. When these large holders decide to move or sell their assets, it can create significant selling pressure, impacting the broader market sentiment and price. Recent on-chain data has shown increased activity from these whale wallets, suggesting potential shifts in their positions or strategies. Compounding this whale-driven volatility is the persistent challenge presented by ETF outflows. Since the launch of spot Bitcoin ETFs in the United States, these products have become a crucial barometer of institutional and retail demand. While initial inflows were robust, driving significant price appreciation, the market has also experienced periods of outflows. These outflows can occur for various reasons, including profit-taking by investors, shifts in market sentiment, or broader economic concerns that lead investors to de-risk. When ETFs experience consistent outflows, it can exert downward pressure on Bitcoin's price, as the underlying asset may need to be sold by the ETF issuer to meet redemption requests. The interplay between whale movements and ETF flows creates a complex dynamic. For instance, a whale selling a large amount of Bitcoin could coincide with ETF outflows, amplifying the downward price pressure. Conversely, a decrease in whale selling pressure combined with renewed ETF inflows could signal a potential recovery or upward trend. Understanding this fragile equilibrium requires a deep dive into the specific on-chain metrics and market data. Analysts are examining the realized cap, which represents the aggregate cost basis of all Bitcoin ever traded, to understand if current prices are above or below the average purchase price of holders. They are also looking at metrics like the net unrealized profit loss, NUPL, to assess overall market sentiment and potential for capitulation or euphoria. The concentration of Bitcoin holdings among the top addresses is another key indicator of whale influence. A high concentration suggests that a small number of entities can have a disproportionate impact on market movements. Furthermore, the daily and weekly flows into and out of Bitcoin ETFs are being scrutinized for patterns that might predict future price action. The narrative of Bitcoin as a store of value is constantly being tested by these market forces, and the current environment highlights the ongoing battle between accumulation phases and distribution phases. The audience impact is palpable, with many retail investors closely watching these developments. Discussions on social media and forums often revolve around whether the current price levels are sustainable, whether the whales are accumulating or distributing, and how the ETF market will evolve. Some analysts believe that the current consolidation phase, influenced by whale activity and ETF outflows, is a healthy correction before the next major upward move, while others express caution, citing potential macroeconomic headwinds and the possibility of further price depreciation. Can Bitcoin break free from the cycle of whale-driven swings and ETF pressures? Now, let's turn our attention to a different major player in the crypto space and explore its potential for a utility-driven boom. Ethereum's structural edge over Bitcoin in 2025, a new era of utility and yield. Is Ethereum poised to redefine its market position by 2025? As the cryptocurrency landscape continues to evolve, a compelling argument is emerging for Ethereum's potential to gain a significant structural advantage over Bitcoin by the year 2025. This perspective is rooted in Ethereum's inherent design as a programmable blockchain, its ongoing technological upgrades, and its burgeoning ecosystem of decentralized applications, dApps, decentralized finance, DeFi protocols, and non-fungible tokens, NFTs. While Bitcoin has solidified its position as the premier digital store of value, Ethereum is increasingly being recognized for its utility and its capacity to generate yield, offering a distinct value proposition that could attract substantial capital and user adoption in the coming years. The foundation for Ethereum's potential ascent lies in its transition to a proof-of-stake (PoS) consensus mechanism, often referred to as the merge. This significant upgrade has fundamentally altered Ethereum's economic model, making it deflationary under certain network conditions and enabling staking. Staking allows ETH holders to lock up their assets to help secure the network and, in return, earn rewards. This yield-generating capability is a powerful draw for investors, particularly institutions and sophisticated market participants, who are increasingly seeking assets that offer passive income streams in addition to potential capital appreciation. Unlike Bitcoin, which operates on a proof-of-work (POW) system and does not inherently offer staking rewards, Ethereum's structure provides a tangible economic incentive for holding and participating in the network. Beyond staking, Ethereum's utility is amplified by its vast and dynamic ecosystem. The network hosts the majority of DeFi applications, enabling users to lend, borrow, trade, and earn interest on their digital assets without traditional intermediaries. It is also the backbone for the NFT market, facilitating the creation, trading, and ownership of unique digital assets across art, collectibles, gaming, and more. As Layer 2 scaling solutions like Optimism, Arbitrum, and Polygon mature and gain wider adoption, they are addressing Ethereum's historical challenges with scalability and transaction fees, making the network more accessible and cost-effective for a broader range of users and applications. This continuous innovation and expansion of use cases contribute to Ethereum's intrinsic value and its potential for sustained growth. Looking ahead to 2025, several factors could further bolster Ethereum's position. The ongoing development of Ethereum's roadmap, including upgrades focused on sharding and data availability, aims to further enhance scalability and efficiency. The increasing institutional adoption of Ethereum, mirroring the trend seen with Bitcoin ETFs, could also provide significant tailwinds. As more regulated avenues for investing in and staking ETH become available, institutional capital is likely to flow into the ecosystem, further validating its utility and economic model. The narrative is shifting from Ethereum as merely a speculative asset to a foundational layer for a decentralized internet, offering both utility and yield, which could differentiate it significantly from Bitcoin's primary role as digital gold. Audience impact is evident in the growing discussions among developers, investors, and analysts about Ethereum's long-term potential. While Bitcoin remains the dominant cryptocurrency by market capitalization and brand recognition, the unique advantages offered by Ethereum's utility and yield mechanisms are increasingly capturing attention. Many believe that by 2025, Ethereum could command a significantly larger share of the institutional market, driven by its robust technological infrastructure and diverse application layer. But will this utility-driven growth be enough to challenge Bitcoin's reign? Let's quickly recap the biggest stories and then wrap up today's show. And that's a wrap on today's Bitcoin Bulletin. We saw institutional interest surging in Ethereum, a U.S. congressman proposing massive government Bitcoin purchases, Bitcoin navigating whale-driven volatility and ETF outflows, and a look at Ethereum's potential structural edge by 2025. Don't forget to smash that like button, subscribe to the channel, ring that notification bell, and drop a comment below with your thoughts on today's news. You can also follow us on all our social channels for more real-time updates. Until next time, stay informed and stay invested.